If we call this meeting to order, we can stand for the Pledge of Allegiance, please. Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Can we get a roll call of the members present, please?
Commissioner Evans?
Present.
Commissioner Good?
Here.
Commissioner Blaney? Here. Councilmember Whitten?
I'm here.
Councilmember Conover?
Present.
Councilmember Biggs?
Here.
Councilmember Graham?
Here.
Councilmember Justin?
Here.
Councilmember Pepperod?
For the last time. For a while.
And Councilmember Rivas?
Here.
And Member David Rose?
Here.
And David Slate?
Present. Thank you very much, Madam Auditor. Next thing on the agenda is approval of our September 2016 Foundation minutes.
Move.
We have a motion on the floor to accept and a second. Any changes or additions or comments? Hearing none, all in favor signify by saying aye.
Aye.
Opposed? Minutes are approved. Capital Cities presentation, please.
Okay, thank you. Good evening, everyone. My name's Amanda Black with Capital Cities, your investment advisor. So I'm here to discuss your third quarter investment report, which you have in front of you, and then it's on the screen for those in the audience. So I'm going to start by turning here to page 1, please. This is where we give a quick review of the market. I'm sorry, if you'll go in one page from that. There you go. So before we touch on your actual portfolio's performance, we like to tell you how the markets did for the quarter so you can have a context in which to understand your returns. So that's what this page is intended to do. So just a quick sort of synopsis. We ended the second quarter concerned about Brexit and the fallout that that might entail in the equity markets. But as we moved into the third quarter, which I'm reporting on today, we found that those concerns really subsided and investors really found more confidence in the markets than a lot of people had expected. In that environment, equities did really well, which certainly benefited your portfolio, and I'll touch on that in a second. And you can see more specifics on the page right there in front of you. The purple bars show equity returns across different styles of equity investing. And even if you can't see the small print, you can see that all of those purple bars are positive. The strongest returns in equity came in the growth style, as well as in smaller cap company stocks, which kind of tells you that risk was in favor. Also, global stocks did really well. Over the last year, you can see those gray bars. That's the returns over the last 12-month period for different styles of equity, and you can see that we've had really strong returns across the board. If you scroll down a little bit to the bottom of the page, we show you fixed income returns. While equity did really well, fixed income struggled a bit, and that's because investors and market participants are starting to think that a rate hike is indeed in the forecast. So all eyes are on the Fed this coming in the next couple of weeks to see if there might be a rate hike. And whenever interest rates go up, that's initially bad for bonds as prices go down. So some of that is already being priced into the market, so bond returns were much more muted than equity returns. With that said, bond investors who had the flexibility to invest in riskier sectors of the bond market, like corporate bonds and even high yield and non-dollar, they did better than more conservative bond strategies. So your diversified mix of bonds in your portfolio certainly benefited you, and I'll talk about that here in a second. So that's a quick synopsis of the markets. Now if we go to the next page, we'll talk about your portfolio specifically. So what we show you on this page, our goal with this summary page is to show you kind of everything that you need to know at first glance looking at this portfolio. So at the top, the two pie charts, the one on the left shows you your actual allocation as of September 30th across all the different styles of investments. The purple slices of the pie are some of your equity funds. The turquoise are your non-U.S. Stocks, non-U.S. equities, and then the blue are your bond funds. We then compare that to the strategic allocation that's outlined in your investment policy statement on the right, and you are exactly in line with your investment policy. So we always like to touch on that. As we go down the page, we have your market value. There at the left, you ended the quarter at $151,462,130. The majority of those assets are invested in mutual funds at Schwab, though we do list some of the municipal bonds that you still hold. In addition to that, they're listed at the bottom of that table. And then on the right is where we show you your returns. So we show you your return for the last quarter. So this is the return for the quarter ending September 30th. Your return was 2.9% for the quarter, so a really strong quarter. And then we show you your since inception return, which is only 2 quarters. That number is 4.4%. Once you have an annual return, once you have 4 quarters, we'll include that in that table. And then at the bottom, this is where we get into a little bit more qualitative detail on your underlying investments. This is a stoplight grid that Capital Cities manages on your behalf. This is a proprietary stoplight grid where we score every one of your investments from both a qualitative and a quantitative perspective, and every single one of your investments have green stoplights. Any questions on this page before I move on? Okay? Sure.
Yeah, go ahead.
Okay. This may not be fair to them asking you to give out your crystal ball, but if the Fed does increase the rates,
Yes.
do you anticipate that the bond market will just be temporarily at a negative and then we'll get back to normal? Because bonds are generally considered more conservative than equity.
Right.
So is that going to only be a temporary glitch?
It's likely temporary, but the definition of temporary is up for debate. So bonds, the thing is, the bond market in general will benefit from an interest rate hike in that investors can purchase bonds and get higher yields for those bonds. What's problematic is what you're holding in your portfolio today, because those bonds become less attractive as new bonds are issued at higher yields. So investors would rather buy the new bond than buy something that you're already holding. So where it is painful or, a bit detrimental to bonds are bonds that you're already holding. Their prices will fluctuate. But keep in mind that your investment managers have the ability to hold those bonds until maturity, at which point there's no actual loss, and real loss. What you'll see, though, are mark-to-market unrealized gains and losses as things fluctuate. So I know that's a lot of detail. But also, in terms of your portfolio, because you have 60% of your portfolio in bonds, we've really been careful to construct that using different styles of fixed income. So you're not just in one single fixed income strategy. You have some short duration or short maturity funds that will be far less impacted by a rate increase. You have some funds where your managers have more flexibility to invest as they see fit, and you would hope that they're investing in ways that protect them from a rate increase. So you really have all different types of bonds, which is helping to mitigate that a bit. In fact, here, fourth quarter to date, so from October 1st through, yesterday, the bond market is already sort of pricing in this rate increase. So it's already being felt, even though it technically hasn't happened. So the Barclays Aggregate Bond Index, which is the broad proxy for fixed income, here in the fourth quarter only is actually down about 3%. Your managers, we don't have the exact data on each underlying manager, but they're doing better than that. So I think the diversification of your portfolio will help in that regard. I know that was fixed income is a kind of a tricky subject right now, so any other questions on that? Okay. Okay, so if you would turn...
I'll get to it.
Oh, sorry.
I was just curious, last time the interest rates moved, it also had an impact on the equity market. Do you foresee a similar kind of a temper tantrum from on the equity side?
I think there are a lot of other factors that are sort of being more impactful to the equity market right now than an expected rate increase. Certainly the election results have been surprisingly positive for the markets, and that seems to be holding a bit. So it's really hard for me to sit here and guess what the equity markets will do with a rate increase. I guess I could only talk about what we're seeing today, and that is that the markets are pricing in a rate increase. It's being problematic for bonds, but equities are still doing fairly well.
And do you think, in terms of the fundamentals, which is what I'm more concerned about anyway, do you think the fundamentals are supporting current prices, or is the market looking?
Well, it depends on where you look in the market. I think everyone would, broadly speaking, the argument would be that valuations are pretty high right now, pretty rich. But there are certainly areas of the market where there's value to be found. Of course, in areas like emerging markets, that's an easy one, but there's more risk with that. But then in smaller, less efficient areas of the market, too, I think valuations are a little more, look a little better to investors. And that's why we think it's really important that you have a mix of active and passive management in your equity portfolio. So you do have active managers who are able to scour the market every day. And, they may not think that valuations are great in information technology, but they may think that perhaps in the consumer discretionary sector, because of some sort of market flip, there's value there. So that's why we find it very important to have a mix of that active and passive management.
Great.
Sure.
With the election, our playing field is going to change a lot, both from a tax perspective, but also from an interest rate perspective. Do you see in the near future us relooking the allocation, or kind of holding steady for a while?
I see you holding steady for now because our goal is to put in place a diversified portfolio that has parts that will work better than other parts in different market environments. We view our job as your co-fiduciary not to guess what the markets might do and hope that we're right, but rather to have pieces in place that will work no matter what. We know sometimes certain pieces, like I said, will work better than others. But that's why we've put together a diversified portfolio. And when I say the word diversified, I don't just mean stocks versus bonds versus cash. I also mean underlying styles of stocks, underlying styles of bonds. I think what's most important for this group, especially in the early stages of this foundation, is to follow your policy, which your asset allocation is very specifically tied to your very unique needs and risk tolerance. So I think that's the best course, is to maintain that asset allocation rather than trying to be swayed by some sort of short-term market phenomenon.
Okay.
Okay, great. So let's look at page 4, please. This is where we show your performance over different time frames relative to other foundations. There we go. Now, you only have 2 quarters of performance history, so please keep in mind that my comments are not as meaningful as if you had 5 years of history. With that said, we always think it's important to compare your performance to a benchmark. In your case, you'll see here that your portfolio had a return of 2.9, that's on the left, kind of down in the middle. We compare that to your evaluation benchmark, letter B, and the evaluation benchmark is what you would have gotten had you just passively managed your portfolio in the exact same asset allocation that you have. So what this shows you is that in the last quarter you had 2.9%, which beat your benchmark of 2.24. That tells you that your active managers added value. If you go to the right, you can see that since inception, albeit only 2 quarters, your active managers have added significant value versus a passive benchmark. The performance target is that 5% bogey. We kind of divide that into the fact that you have 4 quarters. So it's 5% basically divided by 4, and there's compounding in there. So that number is 1.23% for the quarter, 2.47% for the 2 quarters, so you can see that you're outpacing that target. Now, when we compare your performance to a peer group, which is inside that chart, those boxes, you're actually ranking low relative to the peer group, but there's a very good reason for that. You have 60% in bonds, whereas your peer group has 25% in bonds on average. So when I'm talking to you about a quarter where equities did really well, your peers who tend to have more aggressive allocations will do better. So we're not at all concerned about that ranking number. I think what's really important is for you to see that, again, although it's a short time frame, this portfolio is beating all of the benchmarks we've set forth for it. And really, that is the summary of what I had planned to present. As you go through this report, you'll find a lot more detail on every single underlying investment. I'm prepared to talk about any of those. But this is kind of the extent of what I had planned to present, and then I'll look to you for any more questions.
Any questions from the floor? Or from the board?
No, I think it's fine.
Doing
Oh, way ahead of the curve.
Any,
Do we know what the term is on the Hammond Muni?
Yes. So, bear with me a second. So the first of the 3 bonds actually matured in August, about a $1.5 million maturity. There are 2 more set to mature still, and so, you know what, I thought we had that schedule in the back, but what we have in the back are on page 20, there's a schedule of external municipal bonds. I don't have the Hammond schedule in this book.
I think
19
Hammond
or
is paid
20?
off sometime in the 3rd. That's why I think it's off the schedule.
Okay. Okay, thanks, Scott.
But we can double check that.
Yeah, we'll have to double check
I
that.
remember, I think at the last meeting, we talked about the Hammond municipal bonds, and I believe that somewhere, my memory tells me somewhere towards the end of the 3rd quarter, those got paid off. But would still show up here because this is,
And the quarter,
right,
this September.
yeah.
So then that 7 whatever million, that would be invested back into new bonds?
Not into new bonds, it would be invested just as cash coming
Based
into your
on-
portfolio across your whole allocation. And it's also a great chance, anytime something like that happens where there's cash coming in, we use it to rebalance in case some things have moved out of, a little more than others. We bring everything back to your strategic target.
I think, not to argue with Scott, I think they're 18 and 19. I don't,
We could check it.
yeah,
Yeah.
they're not, this one came this quarter, but I think there's 18, 19, 20.
I was just looking at the, with these bonds coming up in the next couple of years, that also gives us some insulation for the rebalancing and the resetting
Mhm.
of our portfolio as we move
Right.
forward. So that, there's sort of some built-in flexibility with those bonds, I think, that come up in the next
Yes,
few years. So
that's
that-
right.
Just if
Mhm.
everybody's getting a little worried about the bond situation, I think we have some flexibility here. That's really all I was trying to say, so.
Yep, thank you.
One more question on page 4. If I'm looking at these returns, is that net of fees?
Yes.
Probably at the fund level?
Yes, net of fees. All of these are net of fees. Net of fees meaning net of investment management fees. Capital City's fee is not netted out of performance,
Okay,
but that's normal
Yeah, that's-
industry practice, yep.
great.
Amanda, question on page 4 as well. When we talk about our performance as compared to peer groups,
Mhm.
and I understand that the allocation is different, we're restricted as compared to the peer groups.
Mhm.
Are there peer groups out there with similar allocations that we can compare ourselves to?
Good question. We use the mid-size endowment foundation peer group because we think you are a mid-size foundation. And really, if we were to try to use something else, I think it would be even less perfect than that. But what we do is on page 3, this is always in your materials for reference, just back one page, sorry. At the bottom, there's a pie chart at the bottom, and it says CAI Endowment Foundation mid-DB database, that's what that is. This shows you the average allocation of your peers. So that's always a nice reference. And what those numbers in parentheses mean, that means 54% equity, 25% fixed income, and 21% alternative. So then we can look at your portfolio and say, well, clearly you're going to fall below your average peer when they only have 25% in fixed income and you have 60. But it is something that you'll hear us continually referring to. And I guarantee you there will be times where you'll look a lot better than your peer group for these same reasons.
Thank you.
Any other questions from the board? Do you have any questions of us?
No, thanks for asking.
All right.
Okay.
All right, thank you very much.
All right, thank you all.
Do our attorneys have anything to interpolate into this discussion?
I don't.
Harold? Nothing? All right. Any other matter that may properly come before the board? I mean, I would only say that at some point, probably in the early next year, we need to, as a board, and we'll have a couple of new seated members after the first, be talking in terms of finalizing whatever working procedure that we want to have for the use of our interest money. That would be things like how much we want to set aside for capital projects, or a procedure so that not-for-profits might make application for grants. So as we near toward the end of this year, I'm happy to send out to you all, or even sometime early January, some working drafts, and you guys can kind of all weigh in, and we can go from there. But at some point, because I'm getting calls and questions, as I'm sure a lot of you are, mostly from not-for-profits, asking how we're going to do this, and I thought it best that we, at some point, nail that down into a proper procedure, so everybody knows the playing field coming in. And that's all I have. Anything else?
Yeah, I'd like to ask, would it be possible for you or someone that's familiar with our account, make themselves available to the two new officials coming on the county council, bring them up to date to where we are and how this all works?
Yes, absolutely. That's something we frequently do. We put together an onboarding presentation to kind of show them how this came to be and some of the thought process behind the asset allocation, and then the selection of managers and where we are today. Happy to do that. So happy if
And Jim, just to let you know, I reached out briefly to Jeff Larson, and when the new councilmen from your district, or your spot, is seated, I was going to give them a little bit of history on what got us here, kind of so they know coming in where we're at. And
Okay.
Yep.
Well, super.
Happy to help.
We'll do it in-house.
Well, we'll jump on the phone if it helps,
Yeah.
so, or put together a document if it helps.
Sounds good. Thank you
Okay.
very much. Appreciate that.
Thank you all of you. Okay?
Nothing else on the board? I'd entertain a motion to adjourn.
So moved.
All in favor?
Aye.
Aye. Have a good